All right, guys, thank you so much for your patience. We're almost ready.
I take it back, it may be 12 o'clock.
No, it melts. We're all start seeing the
Yeah,
Yes, sir.
all right, we're gonna call the meeting to order, 2 minutes late. But for the benefit of our visitors by electronic means. Could we have the roll call?
Yes, Brian Hanson, present. Paul Hammond,
Present.
Lieutenant Colonel Gerald Lohr, Jody Patterson.
Yeah.
Anthony Waskowitz,
Present.
Milton Wilkins.
Present. Let the minute show that Jerry Lohr, Lieutenant Colonel Lohr, is still at Quantico teaching the FBI how to do it right. And therefore he is excused. He indicated to us 2 meetings ago that he'd be away. And we have to have a particular, we have to have a particular motion. And I'll make the motion. I move that Lieutenant Lohr's absence from the meeting today be excused for cause, and that he is attending work training. Second. All those in favor say aye.
Aye.
Any opposed? That's carried. Yes, again. All right. For 25th meeting. Everyone's had an opportunity to review. Anyone would like to propose any modifications or corrections? And motion to approve.
So
All those in-
Aye.
Okay, thank you, Brian. Okay, request for benefits. There are 10 civilian requests. There are 10 civilian requests for benefits. Any questions, comments? Becky, anything further? May I have a motion to approve?
Second.
Okay, Paul and Jody. All those in favor, say aye.
Aye.
All those, any opposed? We have 1 police request for retirement benefits. May I have a motion to approve? Paul,
Second.
Jody? All those in favor, say aye.
Aye.
Any opposed? The application for death benefits. I'm going to do myself right now. Please. There are 1, 2, 3. Correct? Oh, it's split. Yeah, the project split. So there are 3 requests, 2 individuals involved. May I have a motion to approve?
So moved.
Second. Jody and Paul, all those in favor? Aye. And there are no police requests for death benefits. Thank you. We have meetings for the, although they're not on the agenda. Did we have a closed meeting in January? We do have the minutes for that. May I have a motion to approve?
If they're not on, let's hold them to the next one.
Because they're not listed on the agenda.
Are they on the agenda?
No. Vote in the closed meeting.
That's right.
No, it's not. It's not. Just as a performance, I apologize. on the agenda.
Or the return.
Why just wait till approve until next month and put them on the agenda?
Okay, very good. Next item of business, I think we can, turn it over to ACG. Jason, well, matter of fact, why don't you indicate why you're here?
It's fun. Good to see everyone. Some, a lot of familiar faces.
Paul would not be familiar. Would you introduce yourself?
Sure, yeah. So, my name is Craig Coleman. I work at ACG. My prior life, I worked at Summit Strategies Group, which was the investment consultant to the plan. I worked there for about 10 years. At that, while I was at Summit Strategies Group, I was the consultant on this relationship. So it's nice to be back. So I've been in the business for about 20 years. I've done basically all markets research for ACG. Anything research related, but I also spend a lot of time with clients. And as it relates to this morning, Jason is on his way to the Vatican for a client meeting, so he wasn't going to be able to be here. And Finney's wife is sick, and so he texted me at 7:30 this morning and asked if I could, if nothing else, I brought the books. So hopefully we can have a good discussion. But yeah, happy to be here.
Nice to meet you.
Good to see you.
So that being said, I have the very first page here is kind of an executive summary of the plan overall, but I thought, all of the details you can read with the drought can be detailed in the December quarterly report. So we can skip over that and go right into the proposed work plan, which looks like this. So I'm going to share a draft of the work plan for 2024. Today, I'm going to go over the full quarter report, which has the peer ranks in there, and give some perspective on how the plan is doing. I think you already went over the numbers for December, but just a little bit higher level perspective on the plan. And then bring that forward. We also have a January ASAP report. So I'll give a 1 month update on how things are going. We also had, we have a piece in there, just we'll likely touch on this, or we can take it how if you want to go, but we also prepared a equal weight versus market cap weight index. It's just some high level comments there to illustrate some work that we've done as a follow-up from, I believe, the last meeting.
What is the conclusion of the equal weight versus market weight analysis? Is it the conclusion that one should utilize the market weight? Or is it the conclusion that one should utilize equal weight? Or is there a conclusion that it makes sense to do both?
Not both. Our preference would be to do a market cap weighted. I think the punchline there is an equal cap weighted index. What you're going to get is a smaller cap bias, which I think you all know, right? Because you're perpetually rebalancing into, you're getting out of the things that have worked and you're adding to things that haven't worked. That's fundamental rebalancing, which I'll get into with your plan as well, but your active managers will allow you and will to take a lower market cap weight, and long run, small caps should outperform large caps. But you got to go out 15, 20 years to actually see that visibility. That's right.
Just for some context, what we have been talking about was 3-4, maybe it's the October meeting. We had looked at kind of the dismantling of our portfolio and the reassembling. When we take our value manager and our growth manager, what does that bring the concentration in the Magnificent Seven down to?
Gotcha.
So we're just a little concerned about the concentration risk in those names. When you add in the active managers, it came down to market. Right? So instead of being at the time, I think it was like 26.5, we moved to maybe 25.5. Okay. We still had that concentration risk. One of the questions was, does it make sense instead of using the two, the growth, the satellite managers,
Right.
to look at, do you use just an equal weight to reduce your exposure to that concentration?
Yeah.
Brings fees down, but you're also, the performance of the equal weight relative has, not always been good. So
And
that was
I think the other distinction to consider between a market cap weighted index, and this is true of all market cap weighted indexes. They're inherently more driven, meaning whatever's working is going to get a larger and larger weight in the index. And concentration on the other side of the coin, an equal weighted index is inherently going to be more value oriented, right? Because you're always selling the things that are working to get to exactly what you're talking about. That in the hands of a value manager, your value manager, we feel is more appropriate, and they'll always, most value managers inherently have a smaller cap bias, right? Because they're buying things cheap at a more depressed, lower market cap than in the. So in growth, you kind of want to be mega cap. In value, you kind of want to be a little at or below the weighted average market cap. So for us, the weighted average market cap, you can't be wrong, right? If the Magnificent Seven does roll over, your active managers should protect you because they have less of the Magnificent Seven. But if they continue to run, your weighted average market cap is going to keep you in the game. So we like that balance of having the weighted average market cap because you can't be wrong. So that's our take on that. We put some materials in there, but it's heavily returns based. But I think returns are one thing.
Conceptually.
Structurally, I think is for us more of the issue because returns, as you know, are very endpoint sensitive, and in today's environment where you want it to be nothing but large cap, the market cap weighted index outperformed it by 10-15%. So, but for us, it's more structural.
Sure.
So if that checks that box, then let's dive into the big book. It's the December 31st quarterly report. And let's start with, let's go to page 9 of that report. I'm sure Jake and Finney kind of went through the year in review, but I thought I wanted to start here to get some context to the report overall and kind of weave in a story of how that's impacted the plan both positively and negatively. So in that 1-year column, tech across the board, didn't matter if it was US, international, emerging markets, tech is what you wanted to own in 2023. The Russell 1000 growth was up almost 43%. It's a really, really good year. And it was dominated by, as Brian indicated, the Magnificent Seven. But take a look at the most recent 3 months, that last quarter. The story for the quarter for this quarterly book was small cap actually came back into play. Small cap actually, if you look at the Russell 2000 over the 3-month period there, it was up 14%. That was dominated in November and December. Why? The Fed pauses. Small caps tend to do really, really well in a lower declining interest rate environment. Why? These aren't very good companies and they need cheap access to capital to thrive. So the market viewed that as a strong positive. And the interesting note that I wanted to bring to your attention is you see that 14% return over the 3 months. Now go move your eye over to the 1 year at 17. All of the return for the Russell 2000 came in 2 months. So you think this, I think, is a pretty good illustration of what, diversification is. The problem with diversification is you never own enough of what you should have, and you always own too much of what you shouldn't have. For a long time, it's been small cap, and you got it all back in 2 months. When I get to the January report, small caps gave some of that back. But that fever pitch that we saw with AI earlier in the year that has continued on, the market reacts quickly to good news, right? So certainly the small cap portfolio has benefited from that just from an absolute return. The plan has benefited from that from an absolute return standpoint, having small caps play. Similarly, so the next couple of pages just break down sector and country, and what should jump off the page when we look at each of these is on page 10, which jumps off the page for the 1 year, the year-to-date return, the 1 year return, information technology and communication services. Communication services is predominantly tech, what we think of as tech today. but up almost 50% information technology, just that sector.
This comes after a calendar year 2022, where those same sectors traded.
That's right. And
Facebook, for example, was down 50%. Video was down more than 50%.
and then it jumps back to 200%. So maybe Brian, some of the value managers that you would see in large cap. And you're saying, well, you're a value manager. Why do you own some of these magnificent sevens? Exactly what you talked about. Like when I meet with managers and I'm like, well, if you're a value manager, how do you own Tesla right now? Well, we bought it on the dip, right? So value is in the eye of the beholder, and having that ability to go into and out of, we think is good. So in the U.S. market, another thing that we saw in 2023 that was interesting was in the U.S. market, growth, tech dominated, and big caps, mega caps dominated. But when we switch gears to international for 2023, move your eye to the MSCI EFA value and growth net div. It's kind of in the middle of those rows. Value actually outperformed in international markets in 2023. And further, small caps outperformed in the fourth quarter. So why is that? International benchmarks are more heavily weighted towards financials. It still has it's the weight of the index in information technology is only 9% for EFA. I'm on page 12 now. Versus financials at almost 20%. Okay. That has a lot to do with the index construction and less about what's actually moving the market. Okay. So it's just something to be cognizant of when you're looking at the managers. The lines are a lot more blurry on what is value and what is growth in international markets than they are. And it's just purely from an index construction standpoint. And then any questions on the equity front in 2023? Those were some of the most interesting things that I kind of gathered. Now 15 gears to fixed income. Maybe on page 15, in what has been a prolonged challenging environment for fixed income in general, fixed income finally played a role in portfolios in 2023. I'm looking at the 1-year column there, and you see we actually have some attractive absolute returns within fixed income. They're playing their part. Whereas you look out kind of over the 5-year time frame, 1% returns for fixed income. That's what you're going to get in a prolonged low interest rate environment as interest rates rose. Now, it's gotten a little easier to hit 7, because fixed income is actually providing a return. The other punchline with fixed income, which is true across most market environments, particularly upmarket environments, is anything outside of treasuries that active fixed income managers owned led to outperformance. So investment grade corporates, agencies, anything outside of treasuries added value just mechanically, right? Because I can go buy highly secured investment grade corporate, highly paper and just out yield the U.S. Treasury, and your portfolio certainly benefited from that. So that's kind of 2023 in a nutshell. Overall, strong, positive, absolute returns. And that leads to page 20, where $8 million. Yeah. The plan for the 1 year, almost $96 million increase to 2023 with an ending market value of $840 million. So good year for the plan from an absolute return, from an absolute perspective. On page 21, taking a look at current asset allocation, so a little bit overweight equities, particularly on the large cap side, and underweight fixed income. So the only thing to draw here is, in terms of a strategic rebalancing plan can serve as somewhat of a hedge to the portfolio long run as you sell out of things that have done well and add to things that haven't done well. Fixed income is a poster child of that. And I would also say, we're going to talk about real estate and how that's impacted the peer ranks of the portfolio here in a bit. But even real estate, what you get is downside protection. The plan has provided that. But when the market is ripping and there's a lag on the marks for real estate, and your peers don't own as much in real estate, it's going to have an impact there. So it just depends on what you're looking at in terms of defining success. And that is on page 22 is a summary of the total portfolio over a 5-year time frame. There's a couple of things that jumped out to me in preparation this morning. If you draw your eye to the up and down capture in the center of the page, 5-year relative statistics. So this portfolio, the diversification of this portfolio is and has intended to be, getting some upside, but also protecting on the downside through diversification. You're getting that through kind of out of broad benchmark real estate, value growth, large, small, US, non-US. So the downside is 89% versus had you invested just blindly into the policy index, it would have been down 106%. So capturing a lot less of the downside through the diversification and all the efforts of this committee. On page 23 is a longer look at, on page 23, it's a longer look at the same statistics. This is over a 10-year time frame. Again, 85% of the downside, 105% of the upside for the policy index. So all plans, if the balance is protecting against the downside, but still participating in the upside, right? We still need the plan to, capture attractive returns on the upside. And it's done that. It's also done that in a risk efficient manner. Over the last 10 years, it's outperformed both the broad policy index and the strategic policy on a net of fees basis with lower vol relative to the broad market index. And that's just driven by diversification. I was looking at the upper right-hand corner where you see the 6.8% return for the plan, the 10-year standard deviation, and the corresponding Sharpe ratio of 0.5, which is higher than the broad policy index. Let's see, on page 24, so this has the peer ranks in there. When you look out longer term, ideally what you want to see all the time is lower numbers. So 1 is the best, 100 is the worst in terms of its rank or score. So when you look out the 5 and 10 year, and 50 would be median, you're just average. So above median over the 5 and 10 year time frame. Peer ranks by design, like no one is going to look like one another. So it's tough to get a handle on what's happening. But I looked at what do these numbers look like a year ago and 2 years ago. So 2 years ago, over the 5 and 10 year time frame, the plan stood at, it was in the 10th percentile over the 5 year time frame and the 15th percentile over the 10 year time frame. So what happened from 2021 to now? Real estate. Real estate in 2023 underperformed the broader market. You have a 15% weight. Peers may not have, we don't know. We don't know exact. That's the problem with peer ranks. You don't know exactly what they have, but likely an overweight to real estate relative to peers drug that 1 year number down to the 60th percentile in this book. How do we know that? In 2021, real estate was up 24%. Fixed income, the ag, was down almost 2%. So that's that downside protection that I was talking about a little bit earlier. Real estate kind of filled that void, and that's why your peer ranks were so high in the top decile. The other thing to consider when looking at peer ranks is if you ever make it to the top decile, that means you're different from peers. you took bets away from peers, which also means that you can just as easily be in the 90th percentile. So just keep that in mind as you're looking at the peer ranks. It's just one lens to look at and one lens to gauge. But the primary one in our mind should be return. Like, what is the return you're getting to the plan for the pensioners? I'll pause there. Any questions on 2023 and the year at large? Okay. Maybe in the interest, would it make sense now not to go through January and get a more up-to-date performance? Okay. So loose stapled is the January ASAP. Yeah, I've done a couple of things on the market snapshot on page 3. So we had a really good GDP print. 3.3% annualized growth in the fourth quarter was brought growth has continued to, I think, surprise in the U.S. market. And when you think about rate cuts, those are still on the table, and the market is still expecting rate cuts. The risks that we're looking at with that, whenever everyone expects something to happen, and if something happens, anything different from that, that is a shock to the system. So that's kind of one of the things that we're monitoring is the herd mentality of the market, thinking that we're going to continue to start declining rates and continue to decline rates. So that's something that we're cognizant of and mindful of and looking at. So what happened in January? S&P Tech continued to do well. The S&P was up almost 2% in the month of January alone, whereas everything else was flat to down. So a continuation of own the S&P 500, and that's it. So the good news for this plan is you are overweight large caps. You do have exposure to that S&P. So overall, it was a flat month, which we'll get into here in a second. Flat month for the plan on a relative basis. But let's take a look at the Russell 2000. You see how it's down 4%. This is just a breather in small caps. I just mentioned it. It probably had the best quarter that it's had in a decade. Really, November and December. Took a breather in January, down almost 4%. The last chart that I found really interesting was on the lower right-hand corner. What we're measuring here is the market cap of the Magnificent Seven versus some things that you would know. So what jumps out to me is if you would take the Magnificent Seven and you were to add up their market caps, that's that stack bar chart on the lower right-hand corner. Those 7 stocks are bigger than the entirety of the country of China. Just those 7 stocks. And those 7, Apple alone is bigger than the entire weighted the market cap of the Russell 2000. So just to put that in context, I mean, that we spend a lot of time talking about, as we should, the Magnificent Seven, because it's central today to, I think a lot of folks are talking about China and its implication. I think a lot of folks are talking about the Russell 2000, but they are a big player in the global landscape.
Can I just ask a quick question?
Yes.
Can you remind me, what is the rebalancing approach for the plan? Is it automatic or is it somewhat at your discretion? And if it's at your discretion, is the general approach?
As I remember it, it used to be, as benefit payments are needed, we would raise assets in the portfolio to do that, right? So and predominantly it's been taking from large cap. Has been the source of capital. So it's systematic in the sense of benefit payments are always needed, right? I'll have to confer with it. It used to be, you say we need X over the next 3 months for benefit payments, and then you would raise it in January to have it for the next couple of months.
So we're not for benefit payments. The policy is rebalanced an asset class has to be 2 percentage points, 20% away from its target.
Gotcha.
up or down. But that 20% has to equal at least 2 percentage points of the entire portfolio.
Okay. Yep.
So, as a practical matter, most frequently, since we're taking money every month, it's sort of, we rarely actually have to rebalance the portfolio based on policy because we're taking money out every month.
So, and connecting that a little bit to the middle part here, this is large caps, you're rating that as an overvalued bet in real estate. A portfolio is roughly 3 percentage points overweight that exact category. So I just didn't know how to kind of reconcile portfolio positioning overweight versus an asset class that at least is being classified as overvalued.
Yeah.
Should we do anything about that?
Yeah, I know that their strategic rebalancing can provide, it's not a direct hedge.
Yeah.
But it is a strategic hedge, I'll call it that, right? Which is if I take out of the things that are working and I go into the things that are cheaper, I'm taking chips off the table for the things that are wrong. So we would agree that, just rebalancing out of large caps and into fixed income, getting more in line with your target allocation, as I mentioned early on the onset, fixed income is finally providing an attractive return. And that's why they're green there. And these, for what it's worth, are our outlooks over the next 10 years. It's not meant to be tactical, but it's just cognizant of what we all think and feel is, large caps have done really well. And it's hard to sell things that are doing well. But, continuing to utilize the large caps as a source of rebalancing is one way. Another one would be to force a true rebalance back out of large cap and into fixed income. And that should.
Yeah, and that was actually exactly my question. I don't know what the mechanics are. I don't know if the board has asked for that or if we just leave it up to you all, or just because we're sourcing capital for benefit payments, it just happens automatically. So I don't know the mechanics behind that.
I think one of the things is in terms of the real estate, we did ask for a draw, and it takes time.
Yeah.
So I think we asked for 20 million a year ago, and about every quarter we get about $1 million, 2 million, and then that works into the benefit payments. So that actually has been reducing the amount that's coming out of like large cap, but that's correct. Usually large cap is actually typically what's been up in the last year. So usually when we need money, it's coming out of like Jennison on a routine basis, because that's the asset class that is actually outperforming.
In this situation, you're overweight in real estate, but because it's illiquid, it's private real estate.
Exactly.
It's gated and stuck.
Exactly.
So that money is coming out over time and it's new net asset value. Right? So that's, again, the drawback between using some mix of public and private real estate. So now we're having an asset class that's underperforming. Usually you're using to pay benefit plans, you're overweight because of an asset like the Magnificent Seven has run. We want to be pulling out of large cap growth to pay back, and that brings their allocation back. And we took real estate out because everything else had underperformed. We wanted to reallocate, but we couldn't because it was gated. And now we're using that to $1 million to pay benefits instead of getting reallocated. And we're taking less out of the large cap growth things, right? Well, I think we're only in balance now and just on the core real estate, we're still overweight the value add real estate.
I think maybe I could just be more simply said, which is we're overweight by over 3.5% large caps, which are now being considered to be potentially overvalued. We're underweight for bonds by about 200 to 2%.
Mm-hmm.
Should we do anything given your outlook, given the asset positioning? That's all.
Yeah, I mean, it's on the page. I mean, I like for us, getting back to your strategic target and actually rebalancing out of large cap and into fixed income, we think makes sense. you'll always have the liquidity. I know that the fixed income is providing or offsetting some of the benefit payment need that you have as those monies are coming in, but most of the portfolio is fully liquid. We've had a strong run. I glossed over it a bit, and I know Jake's the funded status, it's not the actuarial funded status, I get all of that, but directionally, funded status improved markedly in 2023 and even quarter over quarter. So the idea would be, okay, let's trim out of some of the things that have run and add to some of the things to kind of lock in to a degree, at least from an actual allocation standpoint, some of that game. So, you know, I would feel more comfortable if Jake or Vinny made that recommendation. However, all signs point to, for us, being as close to your strategic policy over the long run. And because it works out today, what you see on this page is what we believe, and it just so happens large cap is a 3% overweight, fixed income is a 2% underweight. I think that makes a lot of sense to just physically rebalance that back to target long run.
Is that like a board vote or?
Yeah, that's,
It doesn't require board vote. It's already in the investment policy statement, so we should just.
Well, but
so
I think,
will you follow up with?
Yeah,
Jason and Penny, just to,
Is that,
I just want to understand when or how that happened.
okay, okay.
Or, and if they need some action from us to cause it to happen.
Right.
Or did they just,
because I think it's by policy, it sounds like they don't have to do anything. So we're kind of saying, but is it sensible to rebalance back to target even if you're not, you haven't hit a trigger in the policy that says you have to?
Yeah, well, yes. Policy says we have to, and if we haven't hit the trigger, we don't have to do anything.
That's what I'm saying, but should we, even though we don't have to, should we?
What's your opinion?
Well, I think given the chart of where overweight asset class that ACG is now calling overvalued, and we're underweight an asset class that ACG is considered to be undervalued, I would say it'd be very reasonable to rebalance closer to policy. And that would put us kind of somewhat acting based off of the outlook here that ACG is presenting. And if it was 50 basis points, I probably wouldn't even think about it, but 3.5% is not insignificant in the portfolio.
Again, this is forever assets and the risk return profile of the targets is what we're after, right? And I think if you just follow a guide, it's almost like the equal weight conversation that we were having. You trim out of the things that have worked well and you add to the things that haven't worked well. This is an example of that. Now, if large caps continue to run, that's the diversification argument, which is you didn't own enough of what you should have. However, taking chips off the table on what has been such a strong market, you're still not going to be wrong relative to your target, right? If you move that down, move large cap down 3%, get fixed income relative to your target, you're more in line, right? So, again, I'll have them follow up the very next month. I don't think anything month over month, but I would feel more comfortable if Jake and Finny has certainly aligned with you all on that. But I think we would probably come to the same conclusion, which is
One of the reasons we have such a high allocation to large cap is because we have a case investment in private equity.
that's right. Yeah.
That's really the reason. Otherwise, that large cap number would be down.
And you need to fund, and that's also another reason why I would prefer to defer to them is like, you may need to have an embedded overweight to equities to offset that profit as you come up the J curve.
That's where we come
the
from.
funding side.
That's where we come from.
well, maybe the question is just, what's the plan to return to the target allocations? And if the plan is, well, the the large cap is gonna be coming out as we fund, private equity, to get private equity target, and the real estate is going to be, as we get those redemptions are gonna be funding the core bonds. That's fine. It'd be helpful to,
Yep, yep. And just optically looking at this page, I think,
And then it's-
so it's like, private, you just can't get to 6.25.
right.
if you look at it in terms of offensive and defensive,
Mhm.
in our offensive category, we have an overweight to large cap, but that's only because we have an underweight to private equity.
Right,
And defensive, we have an overweight to real estate actually, and an underweight. At some companies, we can't get our money out of real estate. So the thing with those terms, I'm comfortable with where we are.
yeah, yeah.
In the aggregate, you're still almost 3% overweight
But not 20%,
on the offense, right?
but not 20%. The
And
large cap, it's not 20%.
No, I wasn't talking large cap, I was talking total. So which is inclusive of the underweight private equity.
Yeah.
So the actual allocation is 65.8, target allocation is 60.
agree with, it's a good conversation to have on both ends. And even the small cap overweight is helping that as well. That's probably a more, well, traditionally speaking, small cap has been the more closely aligned beta to private markets. But in terms of, I'll have the group follow up with this conversation, but my sense is everything you're talking about, we're overweight technically offense to offset the underweight to privates, and that we need more in equity to do that. So maybe in terms of individual managers, we can, so the plan was effectively flat for the month.
Greg, do you know if we have a call on private equity, like private equity, this one? Is there an open call that we have to meet?
I did not have that.
That would.
They would have told me if you did, I believe,
Okay.
but I don't believe that there's an open call.
All right.
Yeah, it's kind of a flat month for the market at large. It gave back a little bit at the total policy level, I mean, 4 basis points for the month. What really, I think, jumps out, from December to today, as I sit here, as I mentioned, if you run your eye down that 1 month column page, you'll see that small caps took a breather. Small caps were down around 4% domestically. On the international side, they were down about 2%. Everything else, big caps were flat. I would also mention your international small cap managers for the fourth quarter had a really good year, or really good quarter. They participated in that upside pop that we saw on the international small cap. So it's pleased to see.
There's been nothing this year.
Yeah. And then, so any questions on January? And the last piece that we had was the equal weight, that I think we covered, but happy to answer anything there. Well, one, just maybe to that, I did find this pretty interesting. I never had seen it this way. It's page 5 of that small cap or the equal weight analysis. And what you're looking at there is anything above that horizontal axis, the S&P outperforms, anything below it, the equal weight performs. And what jumps out to me is I mentioned that equal weight index is always going to be more value oriented, sells the winners, buys the losers. Look at when it really, really outperforms the S&P 500. Early 2000s, tech bubble, and the global financial crisis. So what's happening there is it's that value orientation and the downside. But outside of that, you want to own the market cap weighted index. And markets, long run, go up over time, right? You're going to have these discrete periods but the market is up 80% of the time. It's down 20% of the time. And that's been true. I just found that chart to be pretty interesting. That's really the only 2 periods where it's structurally outperformed the S and P.
The one for 2000, the one for 2007, I recall. Value outperformed great. And in March of 2007, with the interruption, the crash of 2008, it was outperformed.
Yeah.
Pretty dramatic over periods with some interruption.
Honestly, this chart is exactly what I'm talking about, right? I mean, if we're saying concentration risk in the names in the market cap weighted, our exposure to those things, these are 07, I'm sorry, 2000 and 2009. Those are the types of situations you're trying to prevent. And I'm not sure that the active managers who are benchmarking themselves relative to the market cap weighted, right? So they're going to be hesitant to give up the exposure to some of those names. I mean, we have less on the value, we have more on the growth. When you put it all back together, we're very close to the equal weight. And I just, the question is, can you mitigate some of that? And you're right, it's a technical cost. So I'm not trying to say you don't necessarily be permanent, but it would be a way to mitigate the exposure you have in the overall portfolio. Now, you're right, you'll underperform if the Magnificent Seven keep running, you're giving that up. But it's just, I was just looking at it as a risk management tool that
And my response to that would be, you're in between there, which is you have active managers. We all know that it's very, very difficult for active managers to add value long run in large cap. It's difficult. However, the one thing that is active management, the one area, one time that active managers, particularly in large cap, tend to show their stripes is in those periods, right? Because they won't blindly follow the market down like an index. They're actively managing that. That's one thing that you can rest your head on for active management theoretically is that they'll protect on the downside.
and again, we're 60% passive. So we're talking
Right.
about a 20% value and a 20% growth. When you put them all back together, you get not too dissimilar from,
I think so.
from our from our market cap weight. And so my question was, is using the equal weight a better hedge than using the active? You save money on fees and you actually reduce that concentration risk.
I go back to we would tend to prefer to have the active.
Have somebody, let's have somebody actually with their hand on the switch to
Right.
make those decisions
Right.
as opposed to just, okay,
Right.
that's fair. Okay.
Any other questions for me? Oh, I should mention that for this proposed work plan, next month, the follow-up items, we'll talk about the February ASAP and Granite will be coming in. What it's worth there, Granite is another one where you kind of take a look at in period sensitivity. As a manager that I've known for quite some time, and they will always have a smaller cap bias with the average market cap. That is their testament. That's why they're in the portfolio, and they make a good complement to your Smith manager in Ernest. One dynamic that we saw both in the U.S. and the non-U.S. cap was it's really interesting. While small caps did better, if you look at within the small cap index, the bigger cap within the Russell 2000 did better. Does that make sense? So even internationally,
Yeah.
and that is not a good environment for Granite, which is they're more micro and small. And if you were to look at them a year ago, they were in the top quartile. It's just they had a tough year. Now,
By the way, that's, none of the, DFA has a small cap.
Yeah.
vehicle as well.
Yeah.
But they, their bias is to the smallest
Mhm.
of the small caps.
Uh-huh.
And so when the larger small caps were on DFA trails, and the opposite is also true, when the smaller small caps were on they beat the average.
And I think going back to a portfolio construction standpoint, having that manager that focuses on actively the upper end of micro and the lower end of small complements really well to Ernest, which is, look how well Ernest has done recently on a relative performance perspective. Why? They're the upper end of small cap. But a manager that I was meeting with yesterday on the international side, that dynamic existed on the international small cap side as well, which is, and I found it reason why fascinating, which is international small cap in general tend to be more directly tied to the domestic economy. They build, they buy, they produce goods and services for their country, right? They're not global players. So on the international side, the bigger caps within the acquiesce US small cap did a lot better. Why? Because those companies are more global, they have more US exposure. Just found that fascinating. Like international small caps have a much different dynamics than US small caps, but think of when Granite comes in, I'm sure Jeff will talk about that, but hopefully that's a lively discussion. So that's in March. I'll leave it to Jake, and they wanted to provide this. I don't know if this is new to you all, but they wanted to provide this 24 game plan.
Okay. It's Paul Bauer, still on. Paul, if you're there, can you tell us, when do you need us to confirm our target rate of return? Versus, valuation and such?
Well, the goal is for me to present the results at the June meeting. That's been the typical pattern. And if that's how things work out with getting data and such, I would like it no later than May. If I could have it in April, I think that would be ideal. But
April's,
I can live with May if that's the best, if you all need more time.
No, actually, I don't think we need more. I don't think we need more data. As we have done over the last several years, as we have done so, I will ask, Mercer to run our portfolio. And we'll also ask Morgan Stanley portfolio with our model. And so we'll have a couple of additional frames of reference, so to speak, within which we can look at the ACG projections. And as I've said in the past, this is not the same which is right and which is wrong, because we just want to, for our own peace of mind, and answer any questions coming from city county council members or from the county executive's office. Our targets we instead of given what people kind of need your investment given what they're simply reason that's all we're at. You are dramatically higher. Very worked on. We ought to just look into it. And so we'll have that input for the March meeting, I think. And then we can at the March meeting or the April meeting confirm to Paul the target rate of return we believe in, and should be, and it very well may be what 8 point some odd % that ACG is looking at in their model. That's what I think all we're doing here was one of that. Okay. Greg, anything else?
No, that's it. I can answer anything else.
Is there anything else on the agenda?
Just other business comments.
Is there any other business that board members would like to bring up now or put on the agenda for the March meeting? we're open to hear from visitors.
I'll see, you.
We're open to hear from visitors here in the room. And the process is, if you just stand right over here outside, yes. And just, write your name and affiliation and tell us what you, yeah.
I'm Bonnie Miller. I retired from the family in 2019. And my question is really very simple. In the retirees newsletter, it indicated that the board had sent a recommendation to the county council for cost of living increase. So I'm going to be looking for that. And the board, the city council has apparently never acted on it. From what I understand, that you guys sent a recommendation for 2024. What happens next? Like, do you follow up with them and ask them? We go to our county council and say, why did you even act on this?
This was in 2023. That was, it was not in the county executive budget for 24.
Okay, so did they vote?
The county executive did not put in his budget, and the county council didn't insist that it be put in the budget. The recommendations made concurrently to the county under the 500 the ordinance, to the county executive and to the county council. So they both received that recommendation. The county executive did not put it in the budget, the county council did not consider it be in the budget, therefore it was essentially rejected. I would encourage you to call the county council.
That's what I wanted to hear.
Well, you're talking 2024. Is that what you're talking about?
It's not. Yeah, I understand.
Yeah.
People I go to say in county council to the county executive, you know, I've been back almost 5 years without a spot.
You should cover it. Okay, you and Joe said the same, essentially the same point of view. Care to make a comment? All right. Get that from out there. If you're saying anything, Mary, then we cannot hear.
I don't have anything today. Thank you.
Okay, very good. Thank you, Mary. We heard that. Anything else? I will just say one other thing for your information. We have a policy, your information, we have to your question about the possibility. We have a policy that we adhere to. And we will evaluate whether to recommend a to the county council. And the analysis discussion of that possibility takes place at our June meeting.
Thank you.
Okay, if there's no other business or if there's no other business, I guess we can tolerate a motion to adjourn. Someone? It's been moved and seconded by the two most important people here. All those in favor?
Aye.
Okay, it's scary. I guess my wishes for this guy. That's why I'm sure. All right, Mr.
I don't know. That's not a